CommitToWealth.com. Creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. On today's show, we have Richard Wilson. For over 12 years, Richard has been helping 100 million plus net worth families implement solutions to create and manage their single family offices and balance sheets through the Family Office Club. He's the founder of the Wilson Holding Company and the author of the #1 best-selling book in the family office industry, The Single Family Office. So Richard Wilson, welcome to the show.
Thanks for having me here, Juan.
Yeah, it's a great honor. It really is. And I'm excited to talk, and get into this. So my intro was pretty brief. So the reason for that was because I wanted you to go over that. And, there's nobody better that can tell your background and your story, other than you. So let's start with that.
Sure. Mm-hmm. Sure. Yeah, I'll keep it short. But the Family Office Club is a private club. We have 1,750 registered investors. About 300 investors speak on stage at our 25 live events per year. And we have about 900, coming up on 1,000 subscribers who, like Netflix, they pay a month fee and they get to come to our events. And they can come to any and all of them for that membership fee. I think importantly to point out, we also do wealth advisory work for families that are at 100 million plus net worth or who are ultra wealthy and want to develop their direct investment programs. And that's through Centimillionaire Advisors, LLC.
So I guess we can start, off by asking, what is a family office exactly, for those of the listeners out there that don't know exactly what it is?
Sure. Well, there's well over 10,000 of them globally. So if you haven't heard about it before, it's not a brand new thing. Mm-hmm. It's not a word that our organization made up. The word's been around for, generations. But starting 10, 15 years ago, maybe even 20 years ago, families started to realize that they need a more holistic solution than traditional wealth management. If you're worth 100 million or even just 50 million, a little mistake might cost you $300,000. And you could have hired someone full-time just to make sure you didn't make that silly little mistake, didn't forget to fill out a regulatory paperwork. Maybe you've got 20 LLCs to look over. Maybe you've got a lot of deals you're sorting through, a lot of follow-ups, and things need to be orchestrated and done in a more holistic fashion. The wealthier you are, the more true that is. And so there's two types. There's a single family office where if you sold a portfolio of multifamily or self-storage one for $200 million, you might want your own team that's customized to now buying more self-storage or multifamily or whatever you wanted to do and have a whole team dedicated just to you. That's a single family office. The other type is a multifamily office where there's a central architecture and it serves 10 families or 50 families or more. And it's more like a traditional wealth management firm, but more holistic and more geared towards the ultra wealthy.
Okay. And can you tell us about the reasons why somebody would want to start their own family office, so to speak? What are some of the top reasons why?
Sure. Number one is frustration with private banks, wealth management firms, and multifamily offices only providing a defensive portion of their portfolio, but usually doing a poor or horrible job at serving them on direct investments. So most ultra wealthy naturally move towards, over time, having three compartments in their portfolio. There's the compartment of pure defense, which is traditional wealth management, commodities, stocks, bonds, fund managers. Compartment number two is cash flowing commercial real estate. They might hire a property manager or an independent sponsor. Maybe they love an independent sponsor and they're okay going into a blind pool fund, but typically they're at arm's length. They're choosing properties deal by deal, but maybe not operating them if that's not how they created their wealth. That's compartment two. And the third compartment would be direct investing. If they made their money in medical devices or manufacturing, then that's the area where they take the most control. It might look most risky to other people, but they understand that space very well. And it's the one they are most close to day-to-day operationally, and they need less external management and external help. So there's less fees there, moderate fees in the commercial real estate that's cash flowing, and typically a little bit higher fees, but they don't have to do very much at all on the traditional wealth management piece. And if you go to a normal wealth management firm or multifamily office, they're just motivated to have everything be in that defensive bucket. Like, no, don't invest in that self-storage property. Go into our self-storage REITs, because then we get to charge you our wrapper fee on that, and it's part of our assets we manage for you. So that's the conflict, is wealth advisors, do they really have your best interest in mind? Or are they just trying to get their kids through college without being in debt, right?
Mm-hmm. Gotcha. And can you give us some examples of some of the fee structures that you guys do or have? And is it based on more of the, I guess, the value of the assets that they're involved with, or is it more on the family's net worth? What is it? How do you guys do that?
Yeah, really good question. So there's two types of clients we work with. There's one type that needs a full balance sheet solution. They need traditional, they need all three compartments, basically. They need the traditional wealth management and estate plan oversight and figuring out governance and figuring out what to do with transfer of wealth to their kids, everything soup to nuts. And so for that, we have a basis point fee based on their net worth, but we have the capabilities to advise on all three compartments and help them proactively on sourcing deals in manufacturing or sourcing CRE deals, et cetera. So that's important to know. The second type of client, where it's not just 30 to 50 basis points based on their net worth being managed, because that's kind of where the fee range is for these types of families, where a traditional retail client might pay 80 basis points to 1%. Mm-hmm. So it's about half of what traditional families would pay. The second type of client, they might love their Goldman Sachs or UBS, their Northern Trust, whoever is doing the defensive compartment. They might want to stick with them, but they feel like their commercial real estate investments or the direct investments isn't really being organized strategically. They don't have a great focus. They don't have a 14 bullet point strikes on what they say yes to versus not. Their team's not sure about what meetings they should be taking or not, because there's no clarity on exactly what direct investments they're doing and why. And I think that most people are just used to thinking of wealth management as diversification game. But if you want to grow your wealth, you need to specialize and get really good at something. You want to hire independent sponsors who have figured out how to get really good at playing their unique game in the marketplace. And as a family who's created wealth themselves, they know that as an entrepreneur, it's in their DNA. So they want control, and that's why they want to start the family office. So the second type is helping them put together their direct investment portfolio. And if they don't need work setting up their family office, then we'll typically help develop that and just do a 10% performance fee on positive performance within that portion of their direct investment portfolio, and take no management fee and take no retainer, et cetera, to work with the family. But, a lot of families do need some help at the core. So those are the two types.
Gotcha. Yeah, that's pretty good information there. Can you give us maybe some examples that you guys have dealt with here, let's say in the last year, some top three examples that you can maybe share?
Yeah, sure. So one example is a manufacturing family. The father sold for $240 million. And now the family could not work the rest of their lives, but the father wants to pass on what he's learned to the son, to one of the sons who's going to lead in the next generation of wealth creation. So they're going to stick to the same industry where they created their wealth. And their goal is to build another $100 million a year company by buying a $10 million a year or $20 million a year company and ramping that up. So we're helping with the launch of their single family office, helping organize those ideas, helping organize their strike zone, the branding of their single family office to attract the manufacturing deal flow that they want within their industry niche. And but it's it can feel like slow motion. It can be 6-8 months to make progress on some of these qualitative ideas for the family to get comfortable with the process. A couple other quick examples is a $200 million hospitality family that we're helping set up a family office for. And another one is a $300 million fintech family that had an exit and sold his company for over $1 billion recently. For both of those families, we're going to be helping with direct investing and helping with overseeing estate planning, et cetera. But before we get to actually showing them a deal or helping them figure out how to source deals, they have a lot of homework to do typically. On their estate planning might be a complete mess, or they have no governance in place, or they don't have proper accounting or reporting, or they're not documenting things in a way that regulators require. So usually there's a whole lot of messes to clean up for 6 to 9 months, maybe even 12 to 18 months. Mm-hmm. And then as those get cleaned up, you can move to more proactive allocating very strategically. But these are fast moving entrepreneurs. The reality is they're always wanting to just focus only on allocating, only on getting deals done, and like that's in their blood. But that's how the energy shift usually goes, just with helping families sort things out.
Yeah, from what it sounds like is, there is pretty high net worth, families that you're dealing with. Can you give us maybe like an average, a good number average of the net worth that you're helping with?
Yeah, we've got, out of our 4 clients we're working to onboard now, one is below 100 million, but one is at 125. The other one's at 310, and the other one's at 240. But 80% of our clients are between 100 and 1 billion. And over the last 10 years, we have signed up $3 or $4 billion plus clients, and a handful of sub 100 million, but most are in that 100 million to $1 billion. And really, when you get to 30 million to 50 million or more, then there becomes more and more needs for a family office. My most recent book is called Centimillionaire Migraines, and centimillionaire means 100 million plus net worth. Mm-hmm. If there's a word for 30 millionaire, then I would maybe have called the book that, because the headaches start there. Yeah. But at 100 million, you're paying for a family office, whether you have one or not. You're just paying for it in mistakes and fees and chaos and stress, and not the best use of your time if you don't have one.
Gotcha. So you don't really have a lot of, clients that are in the 10 to 20 to 30 kind of range. They're typically a little bit higher than that.
Yeah, typically.
Or higher.
Typically, yeah. The needs really start at the 20, 30, but they just get more intense as you get closer to 100, and they're very obvious at over 100. So the pain is great enough that they feel like they got to take action.
They have to take action, yeah. So this is a question that I like to know is, what percentage of your the families that you help are invested in real estate? And then even further than that, the ones that are invested in real estate, what percentage of their portfolio is in real estate?
Sure. We did a benchmark study of 180 families in the Family Office Club, and 75% of them had a strategic allocation to real estate. And when they did have a strategic allocation, meaning it wasn't just their second, third, fourth home or something like that, then it usually made up 25% of their portfolio. If a family created their wealth in real estate, it's a duality of they may invest 60, 70, 80, sometimes almost 100% in real estate because they just love it so much, they know it, etc. But the challenge is they know it, so you have to really have something special that complements what they're doing, and something that is special enough that even an expert in real estate will love what you're doing to win them over. But they could be an amazing JV partner, if you could. And then, once somebody as a newly became worth 50 million, 100 million, 200 million in their first 2 years of liquidity, they're trying to figure out what sponsors do I trust, what experts do I trust, what consultants do I trust, how do we figure out this game of investing in commercial real estate. But if their family office has been around for 15 to 25 years, they might already have a lot of trusted relationships or kind of know what they're doing. Mm-hmm. So again, you need that much more special of an offering to really break in there and get their attention.
Yeah, I can imagine that. If somebody's already had a lot of success, they're just not going to be able to trust, somebody else that's just coming into the game, or somebody else that has had some success themselves. But it's not going to be easy for them to be able to move over and win them over. On that same note, how do you maybe approach somebody like that? And let's say you do have a pretty good amount of success yourself. How do you approach that and build those strong relationships and build that trust? Because ultimately, I think that's what it's about, is building that trust, right?
Yeah.
How do you do that?
Yeah, for sure. I think you need to respect the investor's time, and part of the way you do that is really know your competition well, know the market well, know yourself well, know the investor well, as much as you can before going into the meeting, and ask a lot of questions once you get there. Because when you approach them, especially the more sophisticated they are, the more deal flow they get, the harder it is for them to say yes to a meeting because everyone's asking them for their time. And the more critical what I'm about to say is true. And that is that you need to get your relevance in the world down to a single sentence of why you're high conviction that you have something that's really compelling in the marketplace. And if you can't summarize why you should matter on planet Earth to them, then they're not going to spend any time doing that homework for you. If it looks like every other self-storage sponsor, every other multifamily sponsor that's hitting them up with an email, they're just going to archive you in less than 5 seconds. But if you can grab them in the subject line or the first line, the single one-liner on the front page of your pitch deck, on your one-pager, maybe give a speech at a local trust and estate planning organization or a local organization of business owners, and the name of your talk has part of your one-liner in there that's really compelling and makes people lean forward. And it should really hit on either a top pain point or mention some credibility aspects or says something that no one else says or shows the unique game you're playing in the marketplace, so that those who are informed feel like that you just hit them between the eyes with a bunch of potential value, and that they've been looking for something like you, or they've never heard of anyone doing what you're doing before. That's the type of reaction you want to get. So that's really important. And then if you want to raise capital from anyone, it took me a decade to realize this, and I've never heard anyone else talk about it, is that you really need to move up these 3 different trust curves. There's the first one, the trust in you as the executive and your team. The second one is your industry or the ecosystem. So if they don't understand how self-storage works or how blockchain works or how apartment buildings work, then it's hard for them to invest. That's why so many investors go into multifamily and self-storage before they'd go into a data center, a warehouse, mobile home park. Most people haven't experienced those things themselves firsthand. So there's a different learning curve. And the third curve, besides the executive team and the industry overall, is the exact opportunity. Like if you have a self-storage unit on 8th Street, do they live around the corner from it? Are they actually leasing space within that? And that would get them highly confident in it more quickly if they know that local area. So if you go into meetings where people don't know you, they don't know self-storage, they're not local to the asset, you're pretty much dead, and you're not going to make much progress, or it's going to take a long time to move them up those trust curves unless you're just simply amazing. And that usually means you have hundreds of millions under management probably. But if you go into meetings where people know your industry very well, then that can really help, right? So if you're investing in medical office buildings, you might decide, hey, let's only raise capital from medical practice owners and dentists and doctors and surgeons. That would be a really smart way to raise capital because they already understand medical office centers, right? You don't have to teach them the ABCs on how big that marketplace is, where the golf club investor or the random family office might not know. And there's family office quality people in the medical industry. The other way to look at these 3 trust curves is that is why everyone raises capital from friends and family first. They're so far up the trust curve on you that they're willing to not be as high on the other 2. But going to local investors is always a smart idea. Going to informed investors is good because the whole capital raising game is about education and de-risking, getting someone to be high conviction on the offer. And that means education, because if they don't understand why you are an expert, why you are credible, if they don't understand the mechanics of the deal, how money is made, if they don't understand the industry overall, then they're most likely not going to invest.
Yeah, that makes a whole lot of sense. I mean, you got to be able to prove yourself and show your worth, as you mentioned. And then also one of the key things that you mentioned was, finding out what their true pain points are, addressing those pain points, like that they can, give you the attention that you're seeking, right? One question that I wanted to ask you as well was, who do you find it easier to work with? And so here's a quick example. Let's say a CEO of a $1 billion company, or maybe a family office that's, a net worth of over $1 billion. Who do you find easier and why?
We really just have entrepreneurs coming towards us. There's a lot of ultra wealthy that created their wealth because they're a partner at Goldman or a big law firm, and they're earning $2 million, $5 million a year, and they might get up to 30, 50 million net worth. But almost all of our clients are people who have had exits in operating businesses, or they sold a real estate platform or took a company public. But a lot of them are people exiting to private equity, and they're coming out with a couple $100 million. That's probably 70% of the clients. And then there's a good 20, 25% that made their money in real estate. So that's where most of our experience is. Dealing with first and second generation is the easiest because I can relate to the entrepreneur in them, and they want that direct investment help for sure. But sometimes the third, fourth generation, they need a lot of help, but sometimes it's hard for them to grasp how wealth is created through, very focused, carefully selected risk taking. Because usually as generations go on, they're just trying not to lose grandpa's money, and there's a lot of mouths to feed in the extended family, and everyone has a claim to the money. And so once you've inherited through a couple generations, even $200 million, when now there's 12 families inheriting that and everyone's going to college and buying houses, even if you maintained the money, just the spend rate goes way up and it gets divided into many little chunks sometimes.
Gotcha. So tell us about your conferences that you hold throughout the year. I know it was, what is it, like 20 conferences that you hold?
Yeah, we do 25 a year.
25.
This year we're doing 25. Yeah, last year we did 17. Next year we'll probably do 32. And half of our events per year are capital raising workshops where we'll go through 30 different strategies on how to raise capital. And we in a single day. And we've got 4 different types of workshops on influence and persuasion, on getting your pitch deck ready, on getting your marketing materials ready, on getting all the fundamentals of capital raising in place. We have one that's kind of like a TED Talks where we have 10-minute talks only from people that have raised $100 million each. They only have 10 minutes to give you their best one idea on what made all the difference in them raising $100 million plus. So out of the 25 events per year, half are those capital raising, intensive training workshops. Mm-hmm. And then the other half are investor summits where you come and you get to hear from 25 to 30 investors on stage in a single day. And it's just a fire hose of investor feedback, interactive discussion panels. You can ask them questions, can network before the event, during the lunch break, during the cocktail hour. And it's more of a connections, networking, and very rapid investor feedback type environment. And you might meet a potential investor or two, or a deal flow partner, or a peer you could keep in touch with, or just get so many insights in a single day from the investors, you change your approach to the marketplace and you go towards it with more context of what might need to be done. And on stage, you'll hear from angel investors, people that run angel investor networks, different types of family offices. So you get kind of this broad array and a more of a feeling of what type of investor might be right for you. And then, like I mentioned at the beginning of the call here, we have like a Netflix type model where you can subscribe for $199 or $299 a month and get access to these events and come to any and all of them that you'd like to. And most people come to 4 to 6 events a year. And we have them in 8 to 10 cities all over the world. So likely we're in an event close to you once a quarter or so coming up. And we've found that's a successful model because nobody else seems to be offering that. The only other thing I'd mention is that we've done 113 of these events now, and we try really hard to make sure at each one that we're just delivering as much value per hour as possible, because I'm kind of an impatient guy and I just don't like wasting my time. I don't like sitting and listening to people typically for a full day. So because of that, we keep things moving with interactive sessions and worksheets, etc. And if somebody does come to an event and they're like, oh my gosh, it was a waste of my time, we give them 100% refund on their price of coming. And no one in our industry does that. We've done that for 10 years now. And it's interesting that no one matches us on that offer. But I think it's corollary to if someone is just, they don't care about our events, they don't care about books, family offices, whatever. They just want to raise capital for their next deal closing in 30 days. I think what I just said is something that all capital raisers can employ. And that's just doing everything for the very long term. Like just plant seeds, build a foundation, create evergreen content like you are with this podcast. If you do everything for the long term, things actually speed up short term because people know that you're doing it for the right reasons and that you're honing your craft and you're dedicated to it.
Yeah, that's some very good advice. You do see that, in a lot of different conferences, people are looking to get to wrap up their next deal, something similar. So they're pouncing on people and just trying to, just collect cards and
right. Yeah. I see that so often, huh?
Yeah. You too. Right. So it's just crazy. Like, they're just trying to pitch their deal. It's like, nobody even knows you, so if you've been in this program maybe before, and we've seen you multiple times, and you start to build that trust, and he's like, this guy is a frequent here.
Yeah, I think that's so important what you just said. I think it's maybe the most important thing on the whole recording, because so many people who come into capital raising rush around with their deal like, hey, I've invented this car engine and it's more powerful than a McLaren, but then the family office is like, I don't even care because I don't know who you are. And it's exactly what you just said. Like, I don't know who you are. I don't know what your process is. I don't know what your focus is. I don't know your background, your track record. I don't know if you've been to jail before for fraud. I don't know anything about you. So I don't know if you have a powerful engine but it's going to be riding on plastic seats with no air conditioning, and the wheel's going to fall off 1 mile down the road because you don't have a team. You don't have anything formalized, right? So I think that is such a huge mistake. And one family office at our 1,000-person annual event, he said, I never do a deal with someone I haven't known for a year or two. And then some people might hear that and say like, oh, well, that's depressing. Family offices aren't for me because, I need to get my deal done right now. But if you ever want to raise larger checks where people are investing $1 million, $3 million, $5 million, $10 million, and a single investor is putting that in, that's what it's going to take is a long-term approach, raising capital in bigger chunks by planting seeds, building relationships. And if you're not in it for the long term, then you should just do something else because capital raising is very hard. And you're probably just going to lose if you're just trying to put in the average amount of effort and a short-term focus on, making some money. Then you're just going to get slaughtered by people out there who are putting in the long-term focus and are doing things for the long term.
Love that. Yeah, you can't be impatient. It's definitely a long-term game. Don't think of it as the short-term, for sure. So on that same note, who is the average person, or what does the average person look like that attends your events?
Sure. So we have usually at the capital raising workshops, we do surveys of the audience. And at a advanced one where the crowd is more advanced, we'll have 25-30% of the room has raised 10 to 25 million in the past 12 months. And the maybe 30-40% of the room has never raised any capital. So we have kind of a full spectrum there. We'll have a couple $1 billion plus fund managers, a couple handfuls that have over 100 million. And then a lot of people who are managing 30 million in assets, 70 million, or just starting. At some of the workshops, it'll be more beginner slanted, but in different geographies, we get different demographics in the room. But operating businesses, real estate sponsors, fund managers, private equity groups, sometimes capital raisers, placement agents are in there, et cetera. Anyone working in investor relations or raising capital for something. And the whole thing is that the capital raising expertise, it's such a specialization area. If you become highly specialized in how to raise capital, you are immensely valuable to many people on planet Earth who would love to tap your knowledge and advice and get your help raising capital. And that's ever more true as more funds start up around opportunity zones and every type of real estate. There's always more competition, which means there's always more people wanting help raising capital or that you could JV with. On the investor summits, those same people are coming to the investor summits as charter members in the family office club, but then also about 25% of the room are made up of investors. So angel investors, family offices, private investors, a few institutional investors. And then the stage is made up of 32, 35 speakers typically. And we'll have maybe 5 to 7 sponsors who've paid to speak there, and then 25 to 27 investors who, again, are those types of investors I just mentioned, but they're just sharing openly on stage what their investment mandates are, what fee structures they like, what legal structures, what new trends are coming, what they hate to see from managers. We'll sometimes have people give their one-liners, and then the family offices on stage will hold up signs and rate them 1 through 10 and say, I have no idea what you're doing. That's meaningless. Or I've heard that 1,000 times, or that's really excellent. I'm curious. I want to learn more, et cetera. And you can get some feedback on your positioning in the market. But that's generally who's attending.
Okay, good. I like that. So, Richard, it is time for our Nuggets of Wealth. These are questions that I ask every guest every week, and hopefully they are able to help them out. So, question number 1, what is a good tool, source, or platform that you use almost daily that can also help others who are looking to get involved with family offices on many different spectrums? But what would you say there?
The best tool is just the act of writing content, as simple as it sounds. So a white paper or a book, and I would start with just a special report or a white paper. And that tool is the best tool for getting a family office to engage with you or a private investor, because you can use that as a basis for getting speaking engagements, having them open an email, having them take a meeting with you, getting the word out about your expertise, et cetera.
Gotcha. Yeah. What is the top advice or tip that you'd give to someone who is wanting to raise capital besides what we already discussed? It's a long-term game, be genuine. Is there anything else that you maybe would want to throw in right there?
Yeah, I think identify a really unique sandbox that you're playing in so that your position is truly unique. And there's maybe 1 or 2 people competing against you, but maybe nobody. Maybe you do multifamily, but only in San Diego, and only multifamily aimed at those people just about to go into senior living, but you're not regulated as independent living yet. You're kind of just catering to, and you have the bingo and the aqua aerobics, and maybe there's a nurse certified person on staff, et cetera, just to help check in on people. And having extra catered services to that demographic, that would be very unique because it's geographically unique, it's asset class unique to multifamily, and you're going into a niche within the niche. The third layer in the pre-senior living. And then you might only have one other person, maybe zero, in San Diego that has that exact approach, and you have a sandbox you're competing in. So people hear what you do, they say, wow, I've never heard of anyone that does that. And even though I live in San Francisco, I know San Diego pretty well, and my daughter went there for school, or we go down there for vacation, et cetera. I could see why you could add value. And I could see that just doing that for 5 to 10 years, you could become a true expert on opportunities and really play that game well. And so choosing the right game to play that's unique enough where you're not going to starve because your game is so unique, no one wants it, no one's looking for it, it's not monetizable, but doing something that's truly unique from others so you can kind of own that term or own that game long term is really critical. That's exactly why any podcast you listen to, someone might be telling you something just to sell you something, and we give away all our books for free to try to get people to implement stuff and use it before they potentially engage with us to actually be a member. But you should always see what people do, not just what they tell you. And at the beginning, I told you our name of our advisory firm is Centimillionaire Advisors. Mm-hmm. And that's because we see nobody out there really catering to the 100 million plus exclusively. But there's 55,000 people globally worth $100 million plus. So if you are, we're a group that can cater to your needs specifically with the strength and direct investments. That's a niche within a niche versus all the multifamily offices that do traditional compartment one defensive wealth management. And I learned that lesson the hard way with Family Office Clubs. We started to do some private equity related deal flow events, and we started to rename it to Wilson Conferences. Well, no one wanted to come to Wilson Conferences. They wanted to come to Family Office Club events. And so, Family Office Club signifies being part of a community of investors. Wilson Conferences, unless you already know me very well, like it doesn't mean anything. It's like saying ABC Capital or, some Greek god capital. Like no one knows what you do. Yeah. It's worthless. It's not working for you. So being niche and then wearing that on your sleeve. So when people see your brand name, see your one-liner, they know exactly what you do and they're leaning forward and they want to take that meeting.
Yeah, that's branding, that's marketing, that's knowing who you are just by reading the name and seeing the logo. So yeah, really
right.
Like
and almost no one does it. Almost nobody does that. So it's a big advantage if you do.
Yeah, and it's crazy how important. I think it's pretty important. It's crazy how important that people don't necessarily make it out to be. They just kind of make up their own names, and which is fine. But you're not gonna. I don't think you're gonna make that much progress either.
We have a branding division internally called pitchdex.com, and we were just working with a client last week. He reminded me of, and they had chosen a brand name from Game of Thrones. It was, and we said, well, why'd you choose that name? It's like, well, I just like Game of Thrones. Yeah, and that's like how much thought they had put into it. And he's a nice guy, and he's a smart real estate guy, but he didn't go to school for branding or marketing or positioning. No. And they just haven't put even one thought into, is this name going to sweat for me every day? Or am I just choosing some random name and, it's just kind of there? And that's what most people do. And it's crazy, right?
Yeah, it is crazy. Yeah. That's pretty funny.
Yeah.
And so, what book are you currently reading? And then we'll get into your two books. But do you have a book that you're currently reading at this time?
Yeah, I just finished yesterday the Game Changers by Dave Asprey. So he has a podcast called Bulletproof Radio on health and fitness and optimizing yourself and kind of biohacking, et cetera. And 10-20% of his content is a little bit extreme or out there on biohacking and experimenting, but it's a lot of self-improvement of your health type ideas. And in that book, he says, well, I've interviewed 500 experts. Here's the most common things they say you should do. Here's the most common themes. Here's the golden threads. And I just like books like that just take a mass amount of insights and then say, well, this is what we're seeing over time as the most important. That's how we put together our book, so I can relate to how value is created through doing that. And the Game Changers book by Dave Asprey was pretty good.
Sweet. Yeah, I had to pick that one up. I haven't heard of that one yet. So tell us about your books. You have the Single Family Office book that, by the way, is very good. And then you also have a newer book called the Centi Millionaire Migraines. So tell us about those.
Yeah. We have we've got like three core books that are most popular. And we keep on putting out more books. They get us our most valuable clients. So the first one, the single family office book, we interviewed 30 single family offices, put all the interviews in the book. We share their models, their common complaints, best practices, what direct investing is, what they prioritize, how to get their attention. And that book's a bit longer. It's 250 pages, but you can buy it, the single family office book, on Amazon, but would rather you just get it for free on our website. It's at familyoffices.com, but we price it as cheap as possible on Amazon just to get it out there. And it's the best-selling book in the family office industry for 3 years straight now. And then that's at familyoffices.com, but at capitalraising.com, we have an 80-page book. It just takes an hour to read, and it's a free book on capital raising. Again, it's on Amazon for $2 or $3, but that book gives you a 5-step system for raising capital. Again, most expensive mistakes. There's webinars, there's educational videos. It's like a $1,000 course on capital raising within a free book. So I'd encourage people to check that out if you're raising capital. And then the third book is the one you mentioned. It's really, what I've learned is that if you can address the exact headaches people have directly, then you'll suck them into your world and you're adding value to their very unique pain points they're having at this point in time. And so that's what we did with Centi Millionaire Migraines. We identified the top 6 headaches of our $100 million plus clients that we worked with over the past 10 years, what 6 headaches they have most commonly, and then developed remedies and solutions and models and tools and resources. And we just give those away in the book. And we give that away at centimillionaires.com, or again, it's on Amazon. But the whole point that someone could take from this is, first of all, is they're one of those books that would just help you move forward in what you're doing. But second of all, is just that it's much, much more valuable to write a book for a very specific audience and dial things in for them and just add as much genuine value as possible to that specific audience than it is to write a 600-page book on like my thoughts on investments or my thoughts on doing well in the investment industry. Like, no one cares. That's not their headache, really, right? Everyone has these more specific pain points and needs, and that's why we have those different books out there.
Got it. Yeah, going back to the pain points right there. That's exactly what you're doing. You're addressing those, and you're also spreading the information out there. And so you can get those all 3 of those books for free. Is that what you said?
Yep, all for free. And if people are just confused about the family office industry, we talk about it a bit within the capitalraising.com book. It's a super quick read. It's literally like a lunchtime read or an airplane read, and you're done. And you'll kind of get the gist of family offices and our approach to capital raising.
Okay, gotcha. So where do you see the Family Office Club in 5 years?
In 5 years, instead of being just in London, Toronto, and Singapore, I see us being in Hong Kong, Dubai, maybe a second city in Canada, and perhaps in Panama as well. I also see us, instead of doing just 25 events per year, 5 years from now, we'll probably be doing 100 events per year. Next year, we're on track to do 32 to 35 events. And I think in 5 years, we'll probably have 75 people on the team versus the roughly 20 that we have on the team right now. And I think that most importantly is that we just keep to our mission of making the whole industry more transparent, more efficient for people to navigate, whether they're raising capital or allocating it. And as long as we can keep up the pace like you do with this podcast, of just adding consistent value, creating content, and documenting our journey, as Gary Vaynerchuk would say, then I think we'll be able to get there.
For sure. I like that, man. You guys are doing a great job. You are doing a great job. So keep that up. Don't stop for sure. Yeah. So one last question, and we'll be done with that. At the end of your life, how do you want to be remembered?
I think our number one core value that's on our wall right over here for our team, we have it in 4 different places on a metal sign. And it's the number one thing I think most important for life, for business, for capital raising, for family offices, is integrity. Not just aligning your morals with your actions, but everything. Who's on your team, what food you put in your body, do you exercise or not, what media do you listen to, what friends do you hang out, where do you live, where's your office, what do you invest in, what do you allow to get on your calendar each day. The more aligned all those things are, then the more progress you can make every day. And so I just think integrity is the most important thing. I've found. So I hope, however people remember me, I hope it's something related to that concept, because I think it can, help in so many ways with relieving frustration, making progress, solving problems, making decisions, etc.
Yeah, that's a great answer. Love that. Where can Commit to Wealth Nation go to contact you and find out more about the Family Office Club?
Well, you're nice enough to allow me to say the URLs probably 20 times already, but at the expense of saying it one more time, I think familyoffices.com. That's where you can learn more about membership, see our event dates coming up, get the free book. So familyoffices.com is the best place to start.
Place. Gotcha. Yeah. Familyoffices.com. Okay. Well, Richard, it was a great honor to have you on the show. I really do appreciate your value, your advice that you have shared with me and my audience. We have definitely learned a ton. So we thank you very much for that and wish you continued success.
Awesome. Thank you for having me on here, Juan.
CommitToWealth.com, creating a legacy by committing to real estate wealth.